Around this time of year, we're typically meeting face-to-face with our shareholders at our annual general meeting and at information meetings in capital cities around Australia. And this gives us the opportunity to discuss the market and the portfolio in more depth, and also for our shareholders to ask questions about topics that they're interested in. Unfortunately, this year, due to ongoing travel restrictions, we're unable to meet face-to-face. And so today we're joined by our Managing Director, Jason Beddow, who's going to discuss the market, the portfolio more generally, and his outlook. So turning to the market broadly, Jason, Australian and global shares have had a strong run since plunging amid the COVID market turmoil last year. This has come despite the continuing economic impacts of the pandemic. What's driven the market's rise?
It's certainly been an extraordinary rise over the last 12, 18 months if we think what the world's gone through and I guess still going through. Central banks and governments, we've moved very quickly this time, particularly in the Western world, to get money into people's hands. And there was a really quick acceleration from a health perspective to give people an opportunity to be vaccinated and to come up with things. So in November last year, I guess the first vaccines were approved. That gave individuals a lot of confidence that there would be an end in sight. We saw that through the Northern Hemisphere. And at that point in time, I think we moved from what will be the outlook from a health perspective to, okay, we can look forward at least, and people started deploying this cash. With record low interest rates, people have been moving into asset classes. We've seen it in property prices globally, equity markets. There's been a bit of a fear of missing out, I think, as things have accelerated, and that we need to get invested because sitting in cash at the moment is a fairly poor alternative. Even though people are moving up the risk curve, we've got very low interest rates, and we're I guess starting to see at least the beginning of the conversation of taking some of that stimulus away.
And you're meeting with company executives on a daily basis. What are they telling you about what they're seeing in the economy more broadly?
In particular, the Australian economy, it's been pretty robust. Despite lockdowns in the most populous states, New South Wales and Victoria, which is a lot of the population, people are still spending. We see the retail sales numbers, and again, I guess the comparisons now are getting a little more challenging. But again, with the vaccination rate really almost world best now at how it's accelerated from being probably quite a laggard, it's a real confidence issue. I think there's a business confidence side of things, and there's also a consumer confidence, and both seem quite good. For the larger corporates, I guess, who we're largely meeting with, the listed companies, most of them, apart from, I guess, the obvious, say, as in a Sydney airport or, an event who have got hotels and cinemas, most businesses have done quite well. There's been, in our mind, more COVID winners than losers thus far. I think at the small business end, the mum and dads and some of the other businesses, that are big employers and a big part of the economy, I think some of the pain is probably being felt in those areas, but not so much in the listed markets. So I think the confidence today is the 11th of October, so I guess it's Freedom Day in New South Wales. And I guess it's a change of strategy for the country, and it's the first state to open up with a number of cases. And I guess we move through the next phase of re-engaging as a national economy and then as a global economy. So I think while confidence remains high, we're relatively optimistic for the outlook.
And speaking of confidence, we've seen a marked increase in merger and acquisition activity over the last 6 to 12 months, including some high-profile takeover bids, the like of Sydney Airport, as you've touched on, Spark and API. What's driving this trend, and in particular in the infrastructure space?
Yeah, it's a good question. I mean, we've actually thought M&A would be quite a hot topic for the last few years as interest rates fell. The costs for businesses to make these accretive acquisitions using debt, or to at least partly fund them, looked more and more attractive. So we're not hugely surprised, and I guess it comes back a little to that previous about confidence. And businesses are clearly confident to transact. The maths on the current economic settings with interest rates and others make it attractive. Infrastructure is an interesting one. If we assume interest rates have bottomed and interest rates are going to rise over time, even though how quickly that happens and to what level, often the more interest rate sensitive sectors from at least a share price perspective, the REITs and infrastructure lag a little with their costs. I think there's a lot of money in the world looking for the, I guess, regular returns and the regular cash flows from these assets, and are happy to take them off market. They don't really want the volatility of the up and down share price, but they're happy to sort of capture that 20-year and beyond steady cash flow.
Recently, we've seen some market volatility with both domestic and offshore factors impacting investor sentiment, the likes of the Evergrande property debt crisis and supply issues. Can you give us your perspective?
Sure. I think, look, China's probably a good place to start. The Evergrande property, is it a crisis? I guess we're not sure yet, but certainly is a change of tact from the Chinese government and what they're doing. Common prosperity is something that President Xi's come out with recently, which again is a different, I guess, attitude to what China's done over the last 20 years since it joined, the WTO and become a part of the sort of global supply chain and global economy. There's been a clampdown on some of their tech titans, some of their very successful businesses, both within China but equally the ones that have listed in the US. So that has people, and rightly so, I think, a little concerned about the trajectory of China's economy over particularly the short term, as we move into the 2022, which is a fairly important year for the Communist Party. Equally, I guess in the Western world, we're also starting to talk about, retracting some of the stimulus. This tapering of the QE or the stimulus because of COVID as economies recover. And economies that vaccinated and we're getting back to normal. And historically, removal of stimulus has often been negative for equity markets. And I think we're just in the middle of that period at the moment where, particularly with equity markets where they are at record highs, some sort of volatility and softening is probably not unexpected.
And in more recent months, we've periodically seen inflation fears spook investors. What are your thoughts on inflation? Is it transitory or is it here?
Well, look, that's one of those million-dollar questions, shall we quote. Most of the economists, I guess, and there's many of those around the world, are still tending to say it's transitory. Back to your question, when we talk to corporates, though, they are seeing significant cost increases, particularly in supply chains. Australia is a big import-export economy, so that's not really flowed through into price rises per se yet, but we think that's probably next. I guess transitory to permanency, a lot of that will depend on wages. If we get into a period where wage inflation is becoming more systemic through the economy, that's a big cost to most Western economies. Inflation may not get out of control, but may actually go through the bands that central banks are comfortable with. Supply chains and the problems that's created, arguably as we go back to a more normal setting, people are travelling more, going out more, maybe consuming less. Some of that should right itself, but we think it's probably here longer than initially thought, and may well be worse. We've got energy prices going through the roof. We've seen what's happening in the UK and Europe at the moment with gas prices, cost of fuel. These things are fairly broad through the economy, and they will have some impact.
Turning to Argo's portfolio, what can you tell us about how the portfolio has been positioned throughout this period?
Look, through most of the period, we've remained largely fully invested. We, I guess at the beginning of COVID, we did sell a few investments we thought may be at risk of having a much more severe impact from the virus. In more recent times, we were a reasonably large shareholder of Boral. We sold and accepted the Seven bid, which gave us a reasonable amount of cash. Another reasonably large transaction was we're a big shareholder of another LIC called Milton, which has been under takeover. We've recently sold down some of our Washington Soul Pattinson holding because that would have become quite a meaningful position for us. On the flip side, there's a lot of IPOs in the market at the moment, and not saying we are throwing our money at all of them, but I think at the moment we're probably looking at about 15. There's a couple of those we think are quite interesting, likely to participate in. Recently, Transurban did a rather large issue for shareholders. They've just bought WestConnex, both tranches. And these are quite big holdings and they're quite big checks to write. And with the market volatility as well, we think it's not a bad time to have a little bit of cash for either new opportunities or just some dislocation in the market as we move through sort of the next couple of months.
Argo holds the big 4 Australian banks in its portfolio, much like a lot of investors in Australia. And with the recent tightening of lending laws, I'm sure they'd be interested to know what your view is. Can you give us your perspective on the banks and also the housing market more broadly?
Yeah, look, the banks themselves are in pretty good shape. A combination of a few things, I guess. The government have been very supportive through COVID with funding, and the banks have taken advantage of that. So in a very low interest rate environment, they haven't really had the pressure on their net interest margin that they would often have in that time. Equally, and I guess for the Australian banks in particular, the housing market, which is such a big part of their book, has been on fire. Property prices annually are huge, and I think residential property is by far now the biggest asset class in the country, bigger than the ASX and all the superannuation assets put together. Equally, over the last few years, and some of this as a result of the Royal Commission, but otherwise, they've been selling a lot of periphery businesses, wealth management, offshore investments, and getting pretty good prices for these. But I guess what may have been missed, and even by us perhaps, is that how much capital was tied up in these businesses that really didn't earn a lot for the banks. So the banks are all sitting on surplus capital. CBA just did a $6 billion buyback, off-market buyback for shareholders. NAB and ANZ currently have buybacks underway on market, and we'd expect Westpac again. So from a shareholder perspective, dividends are back, the balance sheets are in great shape, and they look quite good. I mean, I guess the challenge is now that they're much more domestic focused, kind of saying the same thing, that it's going to be fairly competitive for them to grow once they all, I guess, have similar systems in a similar market. But we think they're pretty good shape, balance sheets are good, and for the investors looking for dividends, and they certainly make up a large part of our portfolio, we think they're back and sustainable.
We're often asked about our holdings in BHP and Rio. What's your view of the large diversified miners, and particularly given the recent falls in the iron ore price?
Yeah, look, they've been interesting investments, I guess. We've seen iron ore price on the back of what's happened in China, and not just that, the rest of the Western world, go from under $100 to $240, unprecedented. And the recent results from those 2 big miners were huge, as were their dividends to shareholders. Equally, the iron ore price has come back. I mean, it is a commodity and it's cyclical. We like the big miners for a few reasons. Yes, they have earned a lot from iron ore, but they do have other commodities. Rio's aluminium moving into lithium. BHP's got copper, and recently announced it's going to unmerge the DLC, or unwind the DLC, and divest its petroleum business to Woodside. So there's quite a lot going on there. We like the diversity and the balance sheets. The other thing is we're fairly optimistic about commodity demand over the next 5, 10, 20 years. The decarbonisation push that the world is on, and the acceleration of that pace, to us means there's going to be a greater demand for commodities, and all commodities. There's the sexier commodities that are linked to these things, like lithium for batteries, maybe rare earths and copper, but equally, steel demand will still be high. There is still steel in wind turbines, and aluminium. So as the world moves into this phase, and governments are very committed, businesses are very committed, and there'll be funding, commodity demand should stay strong. And like the big miners here are good examples. There hasn't been a huge investment in recent time in new supply. So we're relatively optimistic, though they are mining companies, they will be a bit more volatile.
And speaking of decarbonisation, Argo's portfolio has recently included some holdings which give exposure to the decarbonisation and renewable energy thematics. I'm wondering if you could tell us a little bit about these.
Yeah, I guess we've sort of dipped the toe, into that space. I mean, I think it's fairly easy to see how electric cars will become a more meaningful part of, day-to-day life over the next 10 or 20 years. Government incentives, but the technology seems, there now. We've seen that with the high-end like Tesla, but many automakers around the world are committing to a certain amount of all EV over the next sort of 10 or 20 years. Lithium, copper, rare earths are all going to be part of that mix, nickel. So we can see the commodity demand for those. So we think that's a part of the market we'd like to have some exposure to. So we have added Independence Group, which is lithium and nickel. Lynas is a holding we've had for some time, but we think with the current, or I guess the more falling out of the relationship with the US and China, and Australia and China, Lynas with its rather unique rare earths deposit, as in one of the largest outside of China, is more valuable than it was before. Other things we've added to the portfolio that are quite small, Carbon Revolution makes carbon wheels, which again are perfect for EVs. And Novonix is a battery technology provider, which has had quite an extraordinary share price appreciation. But we think the story, which is making battery anode in the US from US material to US customers and taking China out of the supply chain, has probably got more voice now than it even had when we first invested. So I mean, these are all quite small investments for us, and we're always juggling dividend income for shareholders, but we want the growth as well over time, and that's why I think we are quite comfortable having a rather large portfolio, and we do like to play in some of that smaller and mid-cap area from time to time.
Australia is now on the path to reopening its two largest economies. Tell us about what your expectations are for the economy reopening, and with consumer saving rates at record highs, are you seeing another consumer-led rebound?
Look, it's a good question. It's going to be a really interesting few months, I think, for New South Wales and for Australia, as we move from a no-COVID policy to living with COVID, as it seems the rest of the world, or largely the rest of the world are. So that, I think, is a little unknown to see how that plays out. It'll be very individual. There'll be a certain cohort of the economy that can't wait to get out there. Bars, restaurants, live sporting events. Others will be more cautious. And that'll be an interesting thing to manage, I think, for businesses. Equally, the pressure on retail and I think hospitality for staff, and for how do you manage the non-vaccinated and things, I think will be a little awkward. But there'll definitely be some enthusiasm. We're coming into summer. We're coming out of a rather sort of lengthy lockdown. Victoria should follow in the next 4 to 6 weeks. Quite different to, I guess, the western side of the country, Western Australia, South Australia. While they've had little mini numbers, have largely had a fairly normal intrastate existence, even though with hard borders. So I do think the next 2 or 3 months will be really interesting for what happens with cases, how do the public react, what do the politicians do. I mean, my personal view is, we've reached these vaccination rates, which look like we may well get to 90%, that there's no going back. Whether we have mini lockdowns or just there's potentially areas where, there's a certain distancing regime or masks, we'll have to wait and see. But I do think there'll definitely be a propensity for people to want to travel, whether it's overseas just yet, but at least intrastate, if not, across Australia when that's allowed, or at least intrastate where they can. And I guess we'll see. But I think for most of us, we're looking forward to socialising, seeing family. We'll probably be spending more money doing that, going out and travelling than we were maybe getting packages delivered to the door. So maybe there's a little bit of a relief for the Australia Post and others. But look, I think it's going to be a fascinating few months, as I say, because we've had such a mentality of a no-COVID regime, and we've changed that. So I guess we cross our fingers and hope it all plays out well.
Company valuations do seem fairly stretched at the moment. I'm wondering where you're seeing value in the market currently.
Yeah, look, it's interesting. There's been a lot of, I guess, divergence of valuations. Until more recently, there was a little bit of a move, I guess, into value from growth at a high level earlier this year. But the technology companies, health companies have done well and continued to do well. Anything that's, I guess, old world, particularly if it's old world and maybe tarnished with a little ESG, rightly or wrongly, probably where you'd say is the cheap bucket, but then they have their own issues and you need to be fairly careful thinking about those as investments. It'll be really interesting to see what happens with, I guess, we will follow the rest of the world. So if the US Fed give us some guidance come November that they're going to be tapering and rates may be moving forward, we will get caught up in that. I mean, we've had the RBNZ have raised rates. There's 3 or 4 other countries around the world. The RBA is saying 2024. My personal view is, if unless there's another calamity globally with the path of the QE or removal of QE, and even modest inflation in the system, but getting back to some sort of normal settings, whatever the new normal settings are, of course. I wouldn't be surprised if the RBA is going to have to move quicker if the rest of the world is moving quicker as well. So, I think that's a cautionary kind of inflection point for markets. Interest rates are still very, very low. The Australian market yields very high in a global sense. We also have the imputation scheme. So I think, in a general sense, we're still pretty comfortable being fully invested in markets. But some of the more growth-orientated stocks, if interest rates were to move quicker than we expect, is typically the part of the market that gets hit the hardest, because it's based on much further out earnings. But the dividends that we think are back, staggeringly so. Balance sheets look very good in Australia, and we think the economy is generally in pretty sound shape, even though there's little pockets of overheating with maybe residential property, and we've started to see a few moves to maybe cool that, and other things. But generally speaking, we're relatively optimistic, sort of on that sort of 6 to 12 month time frame.
And just picking up on dividends, something I'm sure that everyone is interested to know, what is your outlook for dividends right across the market?
Well, I think the last reporting season we saw in August, I'm not sure exactly what the numbers were, but and off a low. So I guess 12 months ago, the August reporting season in 2020 was the low for dividends. Either dividends were deferred, not paid, the banks had cut, and I think we saw that in our profitability was down about 40%. Looking just at our numbers, the dividends have come back significantly. I mean, the 2 big miners paid out an extraordinary level of dividends. We would argue that's not sustainable, but they're in a position that while they're earning it, they're paying it out. The bank dividends are back, and they're great dividend payers. And also, I guess, a number of companies that did not pay dividends and deferred dividends resumed dividend paying. So you had that as another boost. So look, if I think about our portfolio, there's very few companies now that were dividend payers that maybe are not. Things like Sydney Airport, for obvious reasons. There is just very little traffic. I think numbers are still down 98%, but that should improve from here, assuming it's still a listed vehicle. And a handful of other businesses that are very directly related to travel or people mobility, but most have come back, and so we think there's been a very, very large step up. Look, we don't expect dividends to be able to step up from here again, but we think we're now in a sort of a more an ongoing regime where dividends are kind of back to a steady level, and for those investors looking for a steady income stream from the market, they're probably okay.
Thanks, Jason.
Thanks, Meredith. And I'd just like to thank our shareholders and anyone else who's listened into the video. Usually this time of the year, as we said, we're on the road after our annual general meeting. We love the interaction with shareholders and the questions. So thanks for your support, and hopefully next year we see you face to face. So thank you, and stay safe.